Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Dear students, my name is Dr. S.C. Sardar, retired professor, SD School of Commerce, Gujarat University. Today, we will deal with unit number 3. Its title is Final Accounts of Sole Proprietary Concern. In initial stage, we will discuss about introduction of final accounts of sole proprietary concern. Dear students, as you know that there are different forms of business organizations. The form of business organization includes company, cooperative units, partnership firm, sole proprietary concern, etc. Each firm has to prepare their final accounts for legitimate requirement and for personal use. During preparation of final accounts, accounting principles, accounting rules, guidelines of professional bodies like ICAI, guidelines of statutory bodies like SEBI, provisions of different acts like Income Tax Act 1961, Companies Act 2013, etc. are to be followed by the respective organization. It means final accounts cannot be prepared in isolation by any organization. These provisions make final accounts reliable, transparent, trustworthy, uniform, comparable, and gives so many other benefits to the system. In this unit, we will study final accounts of sole proprietary concern. We will understand meaning and features of sole proprietary concern. Components of final accounts of sole proprietary concern. Purpose of trading account. Content of trading account, in which we will see item of debit side and items of credit side. First of all, let us understand what is sole proprietary. A sole proprietary is a business owned and operated by one person with no legal distinction between the owner and the business. It's the most common type of small business. Some examples of sole proprietorship: storekeepers, bakers, carpenters, and many more. This firm has its own special features. What are the characteristics of sole proprietorship? Let us understand them. Single ownership, no sharing of profit and loss, owner's capital, unlimited liability, legal requirements, one-man control. Let us see in detail one by one. First is single ownership. There are certain business organizations where owners are more than one. This includes partnership firm, cooperatives, companies, corporation, etc. But in this form of business organization has only one owner. Next is no sharing of profit and loss. The profit generated by business owner himself is entitled to that profit, and at the same time he has to bear entire loss if incurs. No other person is entitled for profit and no other person is responsible to loss. Next is one man's capital. The entire capital is raised by the owner of the business. It is his personal capital and providing to the business. Thus, no sharing of profit or loss is done with other person. Next is unlimited liabilities. The owner is personally liable for all debts, losses, and liabilities. Next is minimum legal formalities. In other forms of business, more than one persons are involved, and to protect the interests of all concerned persons, several legal formalities are to be done. Since in sole proprietorship, only one person, and that is business owner himself is entitled and responsible. So, no strict legal formalities are needed. Next is one man control. The entire business run under the control of businessman himself. All decisions are taken by him only. Court matter, the business can be sued or sued in the name of owner. Next is accounting results. No accounting information or final accounts are disclosed in public domain. He can maintain the privacy of his business related accounting information. And the last is easy to tax reporting. No technical and complex tax process is needed. It is easy to report accounting information to the tax authority. Now friends, we will see the meaning of final accounts. Final accounts are an integral part of a financial accounting year for every business. In other words, it is the end of product of accounting process carried out the whole year. This need to be prepared by every business on or by 31st March every financial year, as it marks the end of the year. Final accounts refer to the accounts prepared by a business entity at the end of every financial year. The final accounts depict a clear and accurate financial position of the entity. This information is of use to the management, investors, owners, shareholders, and also to the other users of such information in the big organization. The final accounts of an entity include: the very first item is trading account, second is profit and loss account, and now in modern time profit and loss account is known as income statement also, and the third is balance sheet. Let us discuss this in detail. First, we will discuss about trading account. We will see the meaning of trading account. Trading account preparation is the first stage of preparing final, or it is known as annual accounts. It is a financial statement which shows result of buying and selling of goods and or services during an accounting period. It is credited with sales, services rendered, and closing stock or inventory. It is debited with opening stock or inventory, net purchases, and other expenses like wages, inward expenses, royalty, etc. The difference in two sides is either gross profit or gross loss. When total of credit side is more than total of debit side, difference is known as gross profit, and when total of debit side is more than total of credit side, difference is known as gross loss. In final accounts, two stages are used to ascertain profit or loss of the business. First stage, by preparing trading account, either gross profit or gross loss is ascertained. It is that stage where only direct revenue transactions are recorded. In second stage, profit and loss account is prepared, and where indirect revenue transactions are recorded. From this, we can derive either net profit or net loss. Trading account is disclosing summary of direct costs related accounts of respective accounting year. For further clarity about trading account, let us see features of it. Features of trading account. First stage, the commencement of final account is done with the preparation of trading account. Thus, it is the first stage in the preparation of final accounts of trading entity. Second is direct cost and sales. It records only net sales and direct cost of goods sold. In accounting, one category of cost is direct and another is indirect cost. In trading account, sales and direct costs are recorded. Gross profit and loss. This is third feature. The balance of debit side of this account shows gross profit, and balance of credit side of this account shows gross loss. Fourth characteristic is transfer of differences. The difference of this account is either in the form of gross profit or gross loss. Gross profit or gross loss is transferred to profit and loss account. Gross profit is transferred to credit side of P&L account, and gross loss is transferred to debit side of P&L account. Now, we will see next point, that is about purpose of preparation of trading account. Let us understand purpose. trading account is prepared to determine the cost of goods sold. This is the very first purpose of preparation of trading account. And second purpose is to ascertain the gross profit earned or gross loss incurred. But for which period? For that respective accounting period. This is to be very important note and to be kept in mind by the students. Now we will discuss about content of trading account. Every account has two sides, debit side and credit side. What is to be debited or what is to be credited is based on applicable rules of accounts, and these accounts are personal account, real account and nominal account. Let us see the items which are to be disclosed at the debit side of trading account. The very first item is opening stock or inventory. There can be some unsold stock, and that is closing stock of previous year. It is recorded as opening stock of the current financial year in the books of accounts through an opening entry. Therefore, it is shown in the trial balance. This entry means item is placed at the first item of the debit side of the trading account. The opening stock is of different types. It can be of raw material, it can be of work in progress and finished goods. Second item of debit side of trading account is purchases and purchases return. Purchases means purchase of goods and materials for the purpose of resale or to be used in manufacturing by the business. Purchases account has a debit balance and includes both cash and credit purchases. There can be purchase return if goods are not received as per sample, or defective goods received, or destroyed good is received, etc. is returned back to the supplier, and to that extent purchase is reduced. Purchase return account has a credit balance and showing the returns of goods or material to the supplier from whom these goods were purchased. Thus, arrived amount will be net purchase, and that is disclosed in trading account. Let us see one example on net purchase. Mr. Rajesh of Ahmedabad had purchased goods of rupees 5 lakh from Jayant of Baroda. From these goods of rupees 60,000 returned back to Jayant because goods were not as per sample. Applicable GST is 18%. In this transaction, two cities of Gujarat are involved. First is Ahmedabad and second is Baroda. Therefore, it is a intra-state purchases, means purchases is done within the state and applicable total GST rate is 18%. In case of intra-state transaction, 50% of total GST shall be allocated to CGST and 50% to SGST. Therefore, here 9% CGST and 9% SGST are applicable. Let us have a look on journal entry. When this transaction is recorded in the books of Rajesh, purchase account will be debited by 5 lakhs, input GST account will be debited by 45,000, input SGST will be debited by 45,000 and Jayant account will be credited by 5,90,000 rupees. Now friends, you try to understand over here, whenever you are purchasing any goods or material, at that time input GST is applicable. So this was a journal entry at the time of purchases. Now we will see journal entry at the time of goods return. We have returned the goods of rupees 60,000 to Jayant, but the entry is to be given along with the GST effect. Here Jayant account will be debited by 67,200 rupees, where purchase is returned of 60,000 rupees. So purchase return account will be credited by 60,000 rupees, and to that extent both the GST will be cancelled. So input CGST of rupees 3,600 and input SGST of rupees 3,000 will be cancelled. Once we have debited it and now we are crediting it, so we are cancelling the effect of rupees 3,600 and 3,600 respectively for CGST and SGST. In this case, net purchases is equal to purchases we have of rupees 5 lakh less we have returned the purchase of 60,000. So rupees 4,40,000 is our net purchase and it will be disclosed debit side of trading account. Dear students, let us understand treatment of GSTs. GST is goods and services tax, which is paid on purchases and collected on sales. According to legal provisions, applicable GSTs are paid on purchases are known as input GST, and on sales respective GSTs are collected from customers is known as output GSTs. For intrastate purchases, input CGST, which is known as Central Goods and Services Tax, and input SGST, which is known as State Goods and Services Tax, are applied, and for intrastate sales, output GST and output SGSTs are applied. For interstate purchases, input IGST, which is known as Integrated Goods and Services Tax, is applied, and for interstate sales, output IGST is applied. For each type of GST, separate account is opened and their accounting treatments are given in respective GST account. Input GSTs are debited because these are paid or are payable, and output GSTs are credited because these are received or receivable. At the time of GST filing, differences of input and output GSTs are determined. There can be two situations for differences. First is input GSTs paid are more than output GSTs, difference is receivable from government. In second case, input GST paid are less than output GSTs, difference is GST payable to the government. Now friends, third important point which we have to understand is outward of materials other than purchase return. Besides purchase return, specific outward of goods is also deducted from purchases. For example, goods taken by a proprietor for his personal use, goods given as charity, and goods given as sample. Let us see one example on it. Mr. X of Ahmedabad had purchased goods of rupees 1,50,000 from Mr. Y of Baroda. From these goods of rupees 20,000 donated to the charity and 80% GST was paid on it. It is intrastate purchase, means purchase is done within the state. Here 9% CGST and 9% SGST are applicable. Journal entry for the purchases will be like this. Purchase account will be debited by 1,50,000. Input GST will be debited by 13,500. Input SGST will be debited by 13,500 and Y's account will be credited by 1,77,000. But when you have donated the goods, it is not your sales, you are donating these goods, it is your one kind of expense, so donation account will be debited, and to that extent we have to reduce purchase, and that is why purchase account will be credited by 20,000. In the same manner, the whatever input GST we have paid, that is to be also cancelled. So here input GST account will be credited by 1,800 and input SGST will be credited by 1,800 rupees. This kind of outward of goods is not sales, thus no output GSTs are recoverable. Therefore, to that extent, this input GST shall be cancelled, and for cancellation their account shall be credited. Further, donated goods cannot be part of the cost of goods sold. Therefore, to that extent, purchase shall be cancelled. For cancellation of purchase, its account shall be credited. In case of goods withdrawn for personal use or goods distributed as sample, same accounting treatment like treatment of donation shall be given. Only difference is, instead of debiting donation account, drawings account and advertisement account will be debited respectively. Fourth important item of debit side of trading account is direct expenses. Direct expenses are the expenses incurred on the goods purchased till they are brought to the place of business. In manufacturing concern, besides the above, expenses incurred for purpose of production such as wages, power and fuel, factory rent, etc. are also direct expenses. Let us discuss few direct expenses individually. First is carriage or freight or cartage inward. Any carriage charges paid to bring materials in the godown is direct expense and debited to trading account. Wages. which is paid to worker in the factory including stores are debited to the trading account. Third one is power, means electricity and fuel. Cost of power, that is electricity, and fuel, that is coal, used in running the machine in factory is included under this head of accounts. These expenses are debited to trading account. Factory rent, rent paid for the factory premises as well as the municipal taxes or charges for water etc. are debited to trading account. Fifth is royalties, the payments which are made for acquiring the right to use the patents, it is treated as direct expense. Next is consumable stores. These are incurred to keep the machines in right condition and include engine oil, cotton, waste, soft soap, oil, greases and waste etc. Goods in transit. When goods purchased are in transit, it is necessary to account them also. The amount is debited to goods in transit account. GST paid thereon is debited to respective input GST account and credited to sellers or suppliers account. For example, Mr. X of Rajkot has purchased goods of rupees 50,000 from Mr. Y of Surat on credit. Applicable GST is 18%. On the day of the accounting year, goods is not received and it is in transit. It is intra-state purchases within the state and GST is 18%, thus 9% as GST and 9% CGST are applicable. Journal entry in the books of X for purchases of goods. Goods in transit account will be debited by rupees 50,000. Input CGST account will be debited by rupees 4,500. Input SGST account will be debited by 4,500. When we have purchased these goods, credit, at that time the respective supplier's account should be credited. Here we have purchased goods from Y on credit, that's why Y's account is credited by 59,000 rupees. If it is interstate purchase, IGST account shall be debited. Next point is cost derived from trading account. One of the objective of preparation of trading account is to determine cost of goods sold. But from trading account, two costs can be derived. First is cost of goods consumed and second is cost of goods sold. It is important to note that there is a difference between these two. First cost means the cost of goods consumed is included in second cost, that is in cost of goods sold. We will understand these differences by preparing cost sheet with the imaginary figure. We have opening stock of rupees 25,000. We will add net purchases. Net purchases means from total purchases we will deduct purchase return plus other outward of goods. Let us understand once again the meaning of other outward of goods. You see the arrow. Other outwards of goods includes goods given for donation, goods withdrawn for personal use, goods given for sample etc. Next item we will add in it, that is inward expenses of rupees 15,000. So, total goods available to us is of rupees 5,65,000. From that we will deduct closing stock. So, closing stock is of 35,000. It means the goods which we have consumed is of rupees 5,30,000 and that is why its cost is known as cost of goods consumed. This cost exclusively explain the cost of raw materials used for production. Now friends, after adding direct expenses like wages, rent, power, royalties etc. of rupees 70,000, we will arrive at cost of goods sold of rupees 6 lakh. This cost explain total production cost of goods produced and sold. Now friends, let us have a relook on our discussion in the form of concluding remarks. In this first module of final accounts of sole proprietary concern, we have studied about meaning of sole proprietary concern. A sole proprietary concern is a business owned and operated by one person with no legal distinction between the owner and the business. It is the most common type of small businesses. Number 2, we have observed the different features of this kind of firms. These features are single ownership, no sharing of profit and loss, one man's capital, unlimited liabilities, minimum legal formalities, one man control, court matter, accounting results, easy to tax reporting, etc. The third point which we have studied, that is about the components of final account of such type of firms. This includes trading account, profit and loss account, it is known as income statement also, and the balance sheet are main components. Number 4 is purpose of trading account. There are two important purposes of preparation of trading account. Number 1 is to know cost of goods sold and to ascertain gross profit and gross loss. We have acquired brief information about GSTs in the form of CGST, SGST, IGST, input GST and output GST. Next point which we have observed was about the content of trading account. It is account, thus it shall have two sides, debit and credit. We had discussion of items of debit side in this part, which includes opening stock, purchases, purchases return, goods outward other than purchases return, direct expenses, etc. Items of credit side and its related items we will discuss in the next part 2. Dear students, you are suggested to refresh entire content of part 1 before attending part 2. Keep on refreshing with the smiling face and wait for the part 2. We will meet soon. Thank you for joining us.